A very good afternoon to everyone. I'd like to thank each and every one of you for joining us this afternoon for a technical session titled Expanding Outreach to Mass Markets New Pathways for Balance of Payments Lending. It is my pleasure to invite on stage our esteemed panel for the session. This session will be moderated by Sugandh Saxena, CEO, FinTech Association for Consumer Empowerment. Face, ma'am, please come on the stage. And the panelists include Shubhranshu Chattopadhyay, Director, Business Development, CRIF Highmark. HP Singh, Chairman and Managing Director, Satin Credit Care Network Limited. Ashish Goel, Chief Credit Officer, Ujjivan Small Finance Bank. And Rakesh Kumar, Executive Director and CEO, Light Microfinance. We looked forward to an insightful discussion. With this, I would like to hand over the charge of the session to Mr. Sugandh Saxena.
Very warm welcome to all of you to choose to come to this session. Really appreciate, and very warm welcome to all the panelists. We have been waiting for quite some time to talk to you. And thank you to the organizers for attending this session and giving us opportunity in this bittering cold to come together and share our discussion. This is a discussion where we are looking at mass market. First time when I looked at the title, it was really intriguing because um, when this BOP term was coined by C.K. Prahlad in 2004, almost 20 years ago, so much has changed in the landscape. Um, on a lighter note, we all know BOP, then we have middle class, lower middle class, low income, mid income, and then we also had the psychographic personas, right? Aspirers, strugglers, and whatnot. And now I guess we call it Bharat is a new term. How these terms change is also very fascinating. How we look at the segment, and I think we have much more maturity in the way we ascribe certain terms to them. In terms of supply side, I think there has been fascinating progress. I mean, we all know, we have all read shampoo sachet, but I think things have moved much ahead, not across industry, right? Telecom, entertainment industry, FMCG for sure, consumer good. These industries have made deep penetration into this mass market and have thrived on the basis of that. And our own financial services industry has also, I guess, really progressed very well. Payment, I think, is a clear example of what you can do with the mass market. Same with saving accounts. And of course, in the credit, microfinance was the original BOP sort of industry, but there are other NBFCs who have done an extremely wonderful job. And now fintech industry is a new sort of kid on the block, really impacting the mass market. So that's a very fascinating development, which we have seen different business model working there. And similarly, we see demand also, I guess, is changing. When we look at mass market, actually it's very niche market, right? We call it mass, but there are so many layers to it. And the only way you can serve this so-called mass market is by very niche approach. Uh, and I guess we all know the demography which is playing out. There is a digitalization which is changing the way people look at this, aspirations coming into play, income changing, migration. There's so much happening in this whole mass market, which makes it very exciting and something that we want to talk about. The one piece with which I will, request Subhanshu to start, kick us off with the insights, is there are, I guess, two colors to way we look at the mass market. There's a one color which is very gung-ho about mass market, that okay, this is what it is. Of course, this is after all the India growth story. But then there is a less optimistic side to it, which says that, of course, the demand is there, and therefore perhaps the moral and social imperative to serve them. But is this demand really bankable? Is there a business case to it? And this is where I guess we all come together to see what could be done. So what we want to do in this session, which I think is slightly short in time that we have, is first start with the presentation by Subhranshu. Uh, we had an introduction, right? So you know, Subhranshu, I think many of you would anyway know, is from IFI Mark. They have this very fascinating report, which I refer all the time, called How India Lends. So he would present some of the findings from there, which will give us, I guess, data and evidence to start the conversation. And then we have most distinguished speaker with very deep experience, through which we will do the 2 rounds of, 2 or 3 rounds, we'll see, of discussion. So, Subhranshu?
So what is mass market lending? As Sugandh said, it's a term that's used, but of course, in broad terms, it means that it's products that have faster loan processing, lower customer acquisition cost, smaller ticket, uh, and of course, it's a volume play. It really is a volume play. You by doing this, you achieve greater financial inclusion, and very key to it is how do you build that customer experience, or how do you differentiate yourself in terms of customer experience, because this is not a single product, this is a product basket. That's the first thing to understand about mass market. So what are the nuances of mass market? You've got personal loans. Our general view of personal loans is loans of 2 lakh, 5 lakh, 10 lakh, whatever it is. But how many of you know that there are about 5 crore personal loans that are given of a ticket size of less than 50K? Similarly, consumer durable, two-wheeler, affordable housing, business loan, and commercial vehicle. These broadly, these constitute about 30% of all active loans in the credit bureau. That's a huge, huge number. And it has a significant share of originations. So, as an example, if you look at personal loans, 82% of all personal loans given in India are of less than 50K ticket size. That is why it's mass. Because the supply is there for a demand, it's a volume game, and you need to differentiate over here. If you look at, again, even sub 50K as an example, is a very different market. So 3 out of 5 is actually sub 10K, which means that it's a completely different product, right? You can't build a collections engine for that. You have to underwrite and acquire and deliver that customer experience so that you get the right prospect at the door that gives you the lowest probability of NPA. That is fundamental in that business model. Likewise, same case, if you look at two-wheeler, you see the market that's moved. It's moved because also of things like the Bharat emission norms. So the strategic choice then is, from a bankability standpoint, do I keep my down payment the same, or do I keep my LTV the same? That is the fundamental, and that's why you have to realize that mass market is a very, very heterogeneous market with certain amount of homogeneity in product construct. And there are different borrower profiles. So if you look at it, you look at affordable housing and you see greater than 35 years is about 66%. So it's also a function of the life stage at which you pitch a particular product. That is the only way the product becomes good. That is the only way you time the sell in the right point in the customer life cycle. Significant opportunity to say, I am not over leveraging. Why? Because you have this, which is new to credit. And this is where also interventions like account aggregator, interventions with like the banking transactions, all of these things come into play gradually to do this. Is it an urban story? Is it a rural story? Is it a semi-urban story? It's a pan-India story. It is not that you have demand concentration in a particular geography. It is a pan-India story. Now, very importantly, contextually, Sugandh said two views, right? One is completely gung-ho. The second is, should I be conservative? Now, if you think of it, mass market demand also is being generated by people who've done multiple cycles in microfinance. It's a natural progression of microfinance. So therefore, the question is that whether that population is right served, whether that population is an attractive population from a distribution standpoint, from a credit standpoint, from a portfolio quality standpoint, from a life cycle management standpoint, and whether it is homogeneous or heterogeneous. So we tried to look at what is the persona progression of the microfinance customer. 15% of active MFI borrowers, that's roughly 1 crore borrowers today service a microfinance loan and a non-microfinance mass market loan. 70% of these borrowers have never gone more than 30 days past due on any mass market loan that they have serviced. If you look at from where they are coming, super statistic, positive reinforcement. 73% of people who are taking non-microfinance have a 36-month history in microfinance. So not being necessarily served early. Top 10 states, 71.4%. Again, convergence with existing distribution channels, existing collection channels. I'll skip this. What is key is that anyone who goes 30 plus, with the exception of Tamil Nadu and Kerala, does not come back. It goes to 90 plus. The percentages are very similar. So therefore, if you are building a mass market franchise, it is not that the customer is not there, but a few things are very important for realization. Graduation is not one word. The microfinance customer is looking for multiple products. Those products, because of the very definition of the products, are associated with different risks. And therefore, identifying the riskiness of the product that the customer is asking is key to building a scalable, sustainable mass market business out of this. The other thing that you will see is that we generally tend to think that it's affordable housing, it's business. But great portfolio in terms of consumer durable, great portfolio in terms of personal loan. Second, learning. Look at causal effects of interventions. Rural electrification, Gram Sarak, always have positive correlations with lending products. And finally, the big question, should we be conservative? This is mass market portfolio quality, and this is mass market portfolio quality for a microfinance borrower previously. How different is the delinquency differential in a business loan or a personal loan? Equally attractive. But is it served right? Similarly, two-wheelers. So am I doing it a little too early? Should it be served right? So the big question from the mass market standpoint is two stories. Pan-India story, Different products means different underwriting quality, and of course looking at the life cycle of different products, timing the product with the customer life cycle, and two different cohorts. One, mass market, no microfinance footprint. Second is with microfinance footprint, mass market, and clear stories over here in terms of what is coming out as has been done and is good, and what are stories where some optimization is.
Thanks, Subhranshu. I think you have enticed a lot of people looking at this market. So let's start with the first round. I'm sure you all look this market very closely, much closer than I think me and Subhranshu can look at it. Your take on this mass market, positive, negatives, and be frank. You have about 2-3 minutes to express.
Thank you. So let me just add a little bit more to what you presented. So if you look at microfinance, I think microfinance, we are mass market in any which ways, because of our outreach. But I think what adds up now, by looking at various other products which are coming in, mass market is now happening because the acquisition of a customer has become too digitized. Digitize, when I said digitize, means that today, even for a microfinance borrower, onboarding becomes a question of minutes. Earlier, I remember, when we used to, in our earlier avatar, when we used to actually work on microfinance, acquisition of a customer used to take at least about a week or so. And this I'm talking about after having learned moving from 21 days down to about 10 days, then to 7 days as such. And hordes of cash moving around in the rural space. We were largely predominantly rural. Hordes of cash moving around and giving it to the borrower. Today, with the advent of Jandan accounts, with EKYCs, with Aadhaar seeding happening across over there, an acquisition of a customer becomes too easy. And that's probably one of the reasons why we are looking at mass market in the bottom of the pyramid. Along with that, I think another thing which probably has to be added, and this is just very brief, thoughts, which are there, that it also depends on the state administration of the place where you're working in. And I can just give you quotes to you, looking at when we actually entered the market. UP was like was a no go basically. I think people never used to work at. But when we look at UP right now, post the pandemic, we've had 100% collection efficiency even during the pandemic. Today, for us, an acquisition, we don't work in half of the districts in UP, but still, I think, we have a very large portfolio across over there. And when you look at the penetration is just about, again, 10 to 12% or 15%. That's what the maximum is. So if you have a very steady state government, a very steady state government, I think, you could probably also enhance, your mass market movement, in terms of various other products which can come in. And the other factor also related to this is that, yes, there are states, where you have somewhere, ecosystem where it's very difficult to actually look at microfinance and various other products. And we've seen crisis of Andhra Pradesh, we've seen crisis of happening in Assam, we've seen, maybe somewhat of a agitation part happening in Punjab. Now this actually doesn't bode too well for the expansion of the mass market or the microfinance which we are talking about. But having said that, the power behaviors will definitely emerge out of that, and it will be very difficult for us to do that. And one last point, and this is something which is also getting very significant now. Wherever we see informal markets players now very deeply penetrated into that particular area, you have all the opportunities to look at formal credit coming in and actually working on mass market. I think that is also one of the key takeaways which we can probably look at once we look at mass market penetration moving forward.
I think very good point, particularly on the government, right? I think we simply perhaps take them for granted, given the stability we have had. But I think how important they are in terms of economy and therefore credit per se. Rakesh, coming to you again, you have been little unorthodox in your approach, how you have approached microfinance. What would be your take at mass market? Because you are the one who is very well capitalized, new age, NBFC, MFI, and therefore how you look at opportunities ahead.
Not very different what Mr. Singh talked about, but then a couple of things I would like to highlight. I mean, the entire ecosystem is changing. So we cannot ignore the fact that, I mean, it has been much talked about. So high level, if you look at the ecosystem, there has been changes. There has been changes, major changes in the technology, which is basically, making the acquisition easier, as he explained. Apart from that, regulation has become much more friendly. There have been, some data about the low income households which are being utilized, but the layer of judgment or discretion is very, very thick. If we talk about the utilization of data or data backed decisioning in other products used by other NBFC and fintechs, and that is majorly happening in the urban space, there is a lot of learning, for the incumbents or traditional NBFCs. But those learnings and those will gradually will be utilized by the traditional NBFCs. The major, I would say, the minus or the I would say, in comparison to the urban setup, we have a lack of data about those households. We have a weaker technology infrastructure, but then that is improving. So the data is coming in, and the operating model is also being tweaked. Various formulas are being tried. So definitely there, and the data Subhranshu talked about, so there is learning. I was just thinking whether we should be saying that is a microfinance borrowers record in the retail loans, or retail loans customer record in the microfinance. So we'll need to study them much, but there is a lot of learning over there as well. But the data which he was referring to, it is primarily from urban market. Some of the cases it is from rural or semi-urban market as well. For example, the affordable household, that was 50%. So, and microfinance institution are tapping them, and tapping them very well. So there has been a lot of learning from the traditional NBFCs, working in other product side. For example, consumer durables. So there is huge scope. One of the things which I wanted to talk about, that tier 3 and tier 4, the data was referring, it is more than combined together, it will be more than 35-40%. That is a huge trend. And think about the addition of 33 million customer. Various estimates are saying mass affluent customer by 2026, in rise in income, rise in consumptions. So they are definitely coming up with a lot of aspiration, and that is going to definitely change the composition of products in mass market. So what we used to do in the microfinance industry 5, 6, 7 years back, or even 10 years back, has definitely changed today. And with all these factors, favorable regulation, changes or improvement in the technology infrastructure, additional data being used in the industry, definitely we will be able to tap much more product, and the composition is going to change. So there is huge opportunity. Thanks.
So, Ashish, over to you. And you have very deep experience of 20 years plus looking at different market segment, right? So, not just microfinance, but other segments. How do give flavor to this customer segment as we talk about? It's highly heterogeneous. We try to make it homogeneous, but it's highly heterogeneous. So, from your standpoint, especially Ujjivan, which is first mass market small finance bank coming from urban and semi-urban areas, give us flavor of customer segmentation. Do they expect, can they go to, as a microfinance customer, will I go to Rakesh, for example, light microfinance, if I need a fridge loan or consumer loan, or would I still go to Bajaj and something? So, how easy and difficult it is for make that transition. Help us understand that.
Sure, thank you. I hope this is working. Yeah. So the way I'm looking at it is, go back 20 years. 20 years back, almost the entire country was a mass market. And we saw a theme called consumption rising around 20 years back. And the way it moved was people were looking at livelihoods, then they started looking at consumption. I guess once this happened in the top 10, 15 cities, then it moved on to the next 100 cities. Now it is moving on to all the tier 3 and tier 4, as you mentioned, Rakesh. It's all moving into the tier 3 and tier 4. The first theme that I think that is playing out as we uh, serve the mass market segment is the theme of movement from livelihood earnings to consumption. So if we start plotting geographical graphs, probably we will start seeing how the consumption theme has started playing out in the mass market segment in the last few years. The second thing that we saw in the top 32 cities, let us say, 20 years back, was asset creation. And asset creation created huge markets for home loans. They created huge markets for four-wheelers. They also created large transport, uh, you know, big transport operators. And they created huge assets for the country. That asset creation is now, I see that happening in the tier 3, tier 4. Affordable housing is picking up in a big way. Two-wheelers are picking up in a big way. In fact, two-wheeler is driven largely by the rural households as compared to the urban ones. So that's one theme that is playing out. The third theme, which we saw again in the urban markets 15 years back, was asset monetization. So again, when we pull the graph 15 years back and we start seeing how asset monetization, the entire lab business started picking up, the entire business around gold loans, of course, that was more rural than urban in the past also. But asset monetization is now, we start seeing signs of it in the form of micro lab. In the last 5 to 7 years, micro lab has picked up in a big way. We see the growth in gold loans. It continues at a very fast pace. So those product classes are also gaining importance. So as I see in the overall market, and I'm talking only about assets as of now, but transactions as well. Around 20 years back, we used to say that the bank which has CASA is the king. Today, we say the bank which owns all the transactions of the customer is more likely to do a lot more progress. So it has moved from liabilities to transactions. UPI has helped us in doing that. So that's another wave that is happening as we talk. So in the next 10 years, this mass market will have, components of all the above. One, asset creation. Second, asset monetization. Third, deeper penetration of UPI and transactions. And as we see the, ownership of mobile phones going up, today we say a rough number of 30%, 40%. As this number goes up to 60%, 70%, possibly the next wave of digital lending will happen in the mass market. So that's how I see the journey happening. Right from the segments which we saw in the top 30 cities, right now, going up to all the tier 3 and tier 4 cities in the country.
Thanks. Very insightful. So Brancho, let's skip you and then come back to you a little later. So HP, you have as a NBFC MFI had ventured into affordable housing, MSME, and you come with very different and deep experience working as a microfinance. So, and we have seen, a lot of microfinance institutions who have converted into, say, small finance bank or banks have there's a limited growth we have seen in change of product mix, right? They remain very rooted to microfinance. So help us understand what does it take at an institutional level to make that journey to offer different kind of product? What are the challenges that you see? Some of your experience would be helpful for all of us.
So for us, I think when demonetization hit, the first thought was that can we move away from unsecured lending to secured lending? Because the pain points of demonetization were more uh, relevant and they were more starkly there when we looked at unsecured lending and especially microfinance. So for us, the first thought post demonetization was, can we foray into secured lending as such? And we did. From there on, built up our subsidiaries. Both on MSME lending as well as uh, housing finance. Now, having said that, I think for us, it was not mere just the transition of actually moving away from unsecured to secured, but also looking at the penetration geographically wise, to look at pan India, how we are able to really move across pan India as such, because we were during demonetization concentrated in UP, which was about 55% of our portfolio, Bihar and Punjab. So we were three states, and demon in northern part of India was pretty bad, as such. So we had a lot of delinquency. So for us, the second thought was that, okay, fine, moving away from unsecured to secured, and then can we have a wider reach in terms of geography? And that is what we did. So we, though spreading our resources thin, we moved away from about 5 states which we were working in demon, moved away to about 22 to 23 states, post demonetization. It was a slow process, but yes, that is what we did now. And the other fact, which is very significant to really look at is, all of us, typically the microfinance institutions are rural based as such. Now it is very difficult to actually look at and find people who can actually do rural lab, as was talked about, rural housing, and looking at the missing middle. When I talk about missing middle is, we fix up microfinance to up to a certain level, 50, 60, 70,000, and that's what our outer limits is. And if you look at the average industry size, that's about 40, 42,000 or 43,000. So if you look at a graduated customer, and now this is the missing middle, which really comes in. Now the missing middle will technically have an MSME loan, which could be about 1 lakh, 1.5 lakhs, 2 lakhs. The sweet spot, you, we have seen it in our own institution as the sweet spot being about 2 lakh of rupees. And they've done a couple of cycles or maybe a 3, 4 cycles in with us in microfinance. That's the customer which we look at. And if you look at the entire universe, today we're talking of about 4 to 5 crore customers who are already graduated in microfinance. They're aptly, rightfully there in terms of, and that is what we did. So we're doing micro lab, we're doing micro housing. So every relative need for housing as well as MSME on a secured line, higher ticket size, moving away from microfinance, we are trying to do in these two subsidiaries. Now, if you look at that, then again, rural focus, the challenges are also now pretty heavy. So I don't know, this is too technical for all of you to understand, but microfinance actually battles with qualifying assets as such. So today, for us to do MSME and housing, there is an impediment because we can't cross beyond a certain limit of qualifying assets, and that's what the guidelines talk about, and that's a very big impediment for us to grow. Banks do not have it, but we guys have it. So that's another a big problem which we have to face. And I think somewhat also we are not geared up to really look at these markets. We don't have that kind of an expertise. It will actually evolve gradually. We are proponents of microfinance. But for us to actually learn the nuances of secured lending, MSME lending, higher ticket size, beyond that 50, 70,000 rupees, then housing finance, which is again a very specialized product in rural also. I think for us that graduation also has to be slow and steady, and that's what we are doing. And it's been 4 years since we actually 4 years since we started housing. It's been about 5 years since we started MSME. Today, our non-microfinance products are about 12% of our total portfolio. It's a gradual process, but that's how we want to really build up. And these subsidies of these products are really shaping up very well. So that's what the learnings are, in terms of how we actually moved them from microfinance to these other products.
So essentially, you are saying that it needs a very different kind of treatment of different product, but you have remained rooted to the microfinance in some way. So it's only your customer who have graduated that you serve them with different needs. So Rakesh, coming back to you, microfinance is very distinct in the way it is, right? Group is still dominated in terms of methodology. There's a very strong women focus, which is their doorstep delivery. Physical part is very powerful in the microfinance. Um, and this is what the success is, right? This is how globally microfinance has been successful. So when you look at, say, different product, do you think, you know, your focus loses, or do you think, no, you can perhaps do the multi-product? How do you look at this problem? Because microfinance comes with a very unique kind of expertise, and venturing into this kind of product is a different ball game. We all know that. So what are your thoughts on that?
So, see, I mean, you're right. I agree with you and all other panel members that microfinance is a niche market, certain skill sets, certain processes, some kind of systemic requirement need to be adhered. But if you look at the transition of microfinance, so we cannot ignore some of the facts which has, brought immense changes in the microfinance itself. For example, the JLG model. So JLG model was started because of the lack of choices. Today, if you look at, that is fading away. So almost, we are seeing that the customer has choice, right? So basically, I'm referring to the composition of operating model itself is changing. So it is more individual in nature. If you look at the recent guideline by RBI is talking about the individual household assessment. So, and if you look at the other guideline, apart from the size of the industry, which regulator thinks can create a systemic risk, they have suggested many prudential measures. So microfinance definitely is a niche segment. And in my earlier turn, I was talking about the data. So there has been a lot of data. See, I mean, this customer segment has definitely all those requirements which Subhranshu talked about, the consumer durables, affordable housing. There is no doubt about it. This commercial vehicle. Yeah. So all those products are required. But one of the important things, which I keep thinking at systemic level and what we want to try at Light is that if you look at the customers segment, if you look at the data, of the cash flow of those households, then there are certain patterns, right? So what we try as like we talked about the popular retail or mass loan products being tried with these kind of segments. But if you look at this customer segment, they have some unique requirement. For example, emergency loan. For example, the kind of, so like Mr. Singh was talking about, we do basically 30,000 to 70,000 loan. But don't you think they require 5,000 loan, 10,000 emergency loan? Or, I have seen quite a few borrowers who is well off. If you look at their property, asset, business, and they come for 50, 60,000 loan. Essentially, if you go and verify, you will find they want a credit limit, maybe to meet some certain occasion, festival, working capital requirement, right? So there is a lot of customization required to be done, and there is huge scope. Like talk Subransu was referring, below 50 lakh there has been, I mean, it was a huge percentage. And if you talk about these mass market customers, rural customers, there is huge requirement which can be met through customization. But why we are not able to do? There are, I mean, it is primarily because of the operating model, primarily because of high operational expenditure currently we have been working with, which makes many of those products or customization very very difficult. But I'm sincerely hoping, with lot of disruption or insurgents or learning from the market, from the urban player, fintechs, there is huge learning which is which can be utilized and which is being utilized. I'm hopeful that definitely there will be talk of customer journeys, there will be talk of superior customer experience, there will be talk of various differentiated operating model which will sort of make or bring more customer delight in the form of different set of customers in days to come. And at least at Light, we have been trying to do that. I completely agree with Mr. Singh that this is not going to happen overnight. It will take time, and we have to be patient about it. But at the same time, we'll have to do a lot of experiment, lot of pilots, lot of iteration to learn how to go about this.
Thanks, Rakesh. Let's see, we will be following your journey to how it goes. So, Ashish, coming to you again, in terms of microfinance, we have always seen as a way of approaching customer. Impact has been very powerful part of that journey, that you only give it for the livelihood, you ensure that the customer is not over leveraged, and so on. And the financial literacy, for example, was very strong part of it to ensure that people understand what it means to be credit, because we have seen across geographies very easy availability of credit, while it of course there is a demand for it, could have very negative consequences. We have seen in Kenya, for example, which is still struggling through fintech lending, which was so easily available that half of the population, data says, is defaulters, because people were just not ready what it means to credit discipline was not there. So from your perspective, uh, when we look at mass market, do you think, what are the customer protection issues which you think could come in? And also, I want you to highlight that what do you see at an ecosystem level should be done, so that when we approach mass market, it's a responsible path that all the lenders take, because eventually the it has to impact the customer in a positive way, at least not harm them. So your thoughts on that?
Uh, on customer protection, I feel the biggest risk as the mass market develops would be the risk of too many intermediaries. Intermediaries have had, adverse impact on the overall ecosystem as it develops. Finally, when I, as an institution, is serving as a customer, I need to own the customer. I need to own the relationship. So what I would see as one of the areas of customer protection is, deal directly with customers, keep intermediation to the lowest level possible. The second, of course, is the leverage story. So customers need to be protected. When we're talking about the most vulnerable segment of the society, I guess one of the big customer protection issues is related to leverage. And customers at any point in time, the whole segment cannot get over leveraged, because then comes, a problem with delinquencies. There are other issues as well, which we've not seen happening as of now, which is the identity theft, the issues related to compromised identities, which happen, but they happen in very small numbers. But that could possibly go up if there was an explosion of applications in the market. And again, going back to the first point, intermediaries could lead to this kind of uh, you know compromise in customer entities.
Actually, this is very interesting thought, because normally in a lot of conversation, people talk a lot about partnerships, right? So intermediary, whatever you call them,
Yeah.
but essentially, lot of this distribution network which is available, and credit generalized through this. I mean, at least in the digital side, we have seen this happening. So, but you are potentially saying that it comes with its own set of risk, is it?
So the way I'm looking at it is, intermediaries not in the form of partnerships. So when you are in a partnership, you are, co-owning, co-lending. Those are very valid, and those are very good partnerships where the customer ownership is as much. I'm talking about the disaggregated models where you have people creating loans in the market, and that's where the whole problem starts. And so customer ownership gets diluted in a big way. uh, in terms of the entire way in which we see the digital part moving forward, you mentioned the example of a few countries where the digital part has moved forward. I feel it has two parts of it, external and internal. Externally, I think the ecosystem is developing very well. We're seeing a lot of information A huge amount of information is available in terms of customer transactions. UPI based lending is starting now. We see that it would possibly become one big growth engine in the next 3 to 5 years. So, transaction based lending. Uh, as of now, what we see is the entire digitization has been on the customer journey. Rakesh mentioned about the customer journeys getting smoothened over a period of the last few years. We see that people are now developing analytics for pre-approved offers. Those are happening in a big way. So my existing customers are all getting pre-approved for other facilities. We see that there are big data warehouses getting created now. So as much as we are able to churn out data and make that manual process simpler and put the loan possibly in the app of the customer, that would possibly be one of the ways in which we can make the journeys even more seamless as compared to what we have today. Today, the human touch is very high, the element. Again, that brings in a lot of cost. But once you have reasonable experience with the customer base, it could possibly become, uh, you know, touch free. Few more things which will happen in the economy going forward is all the payments, receipt of payments and making of payments would become an essential part of banking with the customer. So till the time we are lending, we are looking at the lending part, but the moment we start looking at ownership of the customer and raising the exit barriers, we'll probably need to own the customer transactions as well. So UPI, QR code based transactions, all these things will become very prominent in the next 3 to 5 years. So that's how I look at the way the ecosystem needs to develop and how we internally churn out the data to make our customers, pre-approved or easy credit, seamless credit. The second one is again based on the payment-based lending, or make own customers raise their exit barriers using owning up their transactions, and that's how the overall journey, I guess, is going to be in the next few years.
So, Subhranshu, I'll just follow through from what Ashish was saying, customer protection and leverage, and I think it essentially leads to portfolio quality, right? The symptom is comes out in that. So, from your perspective, looking at different asset class, what are the different flavors of customer credit performance you see? And in the earlier panel in the morning, I saw, that in our country, the expectation is that you serve mass market, but you can't have very high portfolio quality because it just makes it unaffordable business case. So how do you see, performance shaping in this mass market products? Are there any risk emerging from the bureau data that you see that would be helpful, and any macroeconomic changes which perhaps comes with the lag, right? It takes a while, 3 months, 6 months, maybe a year, but you would perhaps see them. So how do they positively or negatively impact the credit?
So, Suvan, I think we are big proponents of the view that the mass market products carry differentiated risk. So, what we always advise is that if you are doing mass market, the first construct is what are exclusions? More than inclusions, the first thing to be very clear is what do I not want to do? I don't want to do this ticket size. I don't want to do this geography. I don't want to do this tenor. I don't want to do this persona. If you do that, then as an organization, you have the possibility to use data, both traditional and newer scalable data sets, to create an analytics framework that will give you an optimal approval rate and an optimal portfolio quality. So, if you apply the theory of constraints, there are basically two constraints. One is portfolio quality, the second is approval rate. You optimize one and you challenge the other. Very simply put. So, you need to be clear on exclusions, because in the mind, it needs to be very clear what is it I don't want to do. Once you do that, then you choose which of these two levers do you optimize. And then you go into the market with this model, but without subjective evaluation. Because the moment you start bringing subjective evaluation, then it compromises the possibility for a lender to say, am I rejecting the right kind? And am I approving the right kind? So with time then, you look at what has been rejected and you say, how do I treat it in my asset? Can I treat it through a policy? So that I still stay away from subjectivity. This is the fundamental framework. How do you enhance this? One is that as you go into mass market, if you are a newer entrant, you need to be clear that to scale this up, you need to be able to monitor it at shorter frequencies. And monitor it not just on your own data, but on external data as well, which could be bureau benchmarks or things like that. So therefore, you make the technology choice. What do I insource and what do I outsource? As a lender, the preference should be to insource the customer interaction, both prospecting, lead management, acquisition, post-stack. You can outsource this credit engine till the time you develop the in-house capability to bring it in-house. If you do that, then the story will come around. The other advantage that you have is this allows the lender to keep on adding newer scalable data sets like the transaction. Now, if you look at interventions, for example, we've had this intervention through Jandhan and UPI, right? We've had this intervention, Jandhan, UPI, eKYC. Now we've also had this buy now, pay later intervention. So now suddenly you are going to find a lot of people who otherwise you would have found new to credit. But you would find people with credit, short credit, short credit, short credit. How do you treat that? That is the decision. Next, you have this intervention which is creating this marketplace, ONDC. ONDC plus GST is going to bring this unorganized retail, unorganized merchant data into the system in a hugely scalable manner. So how do I use that? And then you put token on top of it, which is short-term capital, working capital lending. So these data sets will be created in the external ecosystem. The strategic choice, I think, is from a business design and business strategy standpoint to be clear on what is my exclusion, and from an implementation tech stack strategy to say, do I want to own everything? Or am I better off insourcing my customer interaction? Because ultimately, it's like in the old microfinance, 3 lender, 4 lender philosophy. You saw that people who were with 2 lenders had much better delinquency rates. So as my customer is migrating, I want to own the customer. So I'm better off using all my resources, people, tech, money, budget, owning this interaction. Whereas getting someone to own this credit engine for me till I'm able to scale this model while I bring it in house. I think fundamentally that is what we are seeing. So people who come to us and say, assist us. Earlier it was, I will do 100%. But we are seeing the philosophy veer to this. And that I think is a good thing for the story.
And just, one point on the macroeconomic. So how do you see that sort of shaping the credit behavior or uptake or everything else?
So obviously demand has increased, but we have to factor in that part of the demand is also pent up demand. So I think that is something that we need to be cognizant about and factor that in when we say what is going to happen in the short term, in the short to near medium, till the medium. That is number one. Second is post new regulation for microfinance. The book is still a very young book. So it is important to be cognizant of that, that it's a young book and it is still seasoning. And look at what that seasoning is. So, for example, post demon, when the new book started at Feb 2017, you looked at it at March 2018 and you said, now what was sub 1%, what is this now? So, I think that is something that is there. Having said that, from a credit score standpoint, generally when you score, you look at 36-month history. So if you now look at now and go back 36 months, you still have that, you are still in the cycle where the effects of all the interventions that were made, whether it is morat or restructuring, that is still present in the credit record. So your credit scores will change in another 15 months or so. That is the third thing to be cognizant about. And of course, account aggregator. I think account aggregator, the great thing with account aggregator is that because such a large volume of our UPI transactions are consumer to consumer transactions, without customer intervention for categorization, over a period of time, you will not be able to get too much sharpness out of it. So it's important for me to say that this Bharat Pay merchant that I pay every second day is actually a fruit seller. So that I think is also directionally what everyone will try to work on to improve the categorization of the C2C UPI transaction.
So I'll come to Rakesh now first. So just, and I know you're trying to look at digitalization as a, sort of, you're working in that direction. How can you make this loan available to customer in a digital way? You're looking that space very closely. And, Ashish talk about, journey from livelihood to consumption, but there's also very strong demand for convenience, right? I think fintech lending has thrived precisely because it's a very convenient 24/7 lending which happens. And there is a demand for that, right? People do want, they can't plan for everything, and they do want this kind of credit for emergency, for buying things just out of nowhere, and so on. So from your perspective, how do you, when do you think, being rural, your customer can actually take a loan on the app? How far we are from them, from that situation where that can happen? How do you see that your customer, which is also a very traditional customer, like it's a rural women, uh, loan is, her phone is shared, maybe she doesn't have access to phone, data point I don't know, there are a lot of challenges around it, and, phone history, issue of privacy is very important because there would be some inhibitions about it. Where do you, 5 years, 10 years, when do you think we will see your customer seamlessly completing her journey on phone?
Yeah. So first of all, I will not make all the audience hungry for. So I'll be quickly answer these questions. See, I mean, Sugandh, I indicated towards all those opportunities, and I also said that there is huge gap. The set of customers we are talking about, the fintech lenders are working, their technology infrastructure, huge data, including the payment, and they are digitally literate. They can do a lot of things. So there is huge difference between the rural customer, but definitely, I mean, some of the things can be done. But at the same time, somehow I feel like aggregator model, Suramsu was indicating. So there are different models. Definitely, if we are saying that the current microfinance model, operating model, is going to, sort of result into that kind of customer experience or journey, I doubt that I mean this operating model has inherent limitations. But there are various models being tried out. You yourself, work with lending tech companies. So some of them, or or combination of them, can be tried. One thing is very, very clear to me that in order to tap this business potential or to bring that kind of experience, the combined experience is required. The agility, the tech investment, different kind of resource from the fintech companies, but at the same time, like you talked about customer this compliance issue, I mean their experiences where they will go. So basically the risk part, the compliance part, of course the distribution model, how to scale these things, the traditional companies have expertise. So both the set of expertise need to be combined, and from there definitely different formulations like aggregator model, sub tweaking over there should be tried out. I don't have the answer to this question how that will happen, when that will happen, but definitely those need to be tried. I'm also sincerely hoping that definitely new formulation, new and differentiated distribution model will soon come up to tap all these customers, and also to address those customers. So these customers would be starting with the assisted model, so it will take some time for them to graduate to the self-serving mode. But once that starts happening, so it will rapidly transform the customer segment. The when that tipping point will come, it's difficult to say at that moment, but definitely those changes I clearly see going to happen.
No, that's a very realistic observation, because once we move out of sort of Delhi and go to suburbs, uh, I think it's very clear that there are different markets and they are so different. Just in 5 kilometers, things fundamentally change. From a very sophisticated, urban, tech-savvy customer, you reach to a place where there's nothing, right? People are using smartphone for very different reasons, so that data perhaps is not usable. And therefore, I think it's very important for lenders to be rooted in where their customers are, understand them deeply, and then do these things, because it might sound very fancy, but it may not work in real situation. So I think we are almost time, but I think we have 5 minutes perhaps for some questions. Uh, yeah, yeah. No questions, all clear. Yeah, you have most experienced lenders in front of you.
Pransu.
From? Sorry, can you introduce yourself and then?
Hello.
Yeah.
Am I audible?
Yes.
So I have one question from the Mr. Subhranshu to get some clarity on the data. He has presented for CRIF High Mark, where the microfinance customer having a footprint on the retail space. So have we also you have done some analysis on the household level? Ki how many household having a footprint in retail market? When I'm talking about a household, means the microfinance household. And what is how this numbers looks like, the 15% penetration versus if we take this data up to household level, how this numbers look like?
See, it's very difficult to do a household analysis from the bureau. So, if we try our hand at it, we will be able to do it with a degree of accuracy that we believe is not good enough for policy making. So that's why we've consciously stayed away from it at this point. But some of the forward-looking directions that the microfinance industry is working on, it may give us the possibility in the medium term to do that analysis.
Okay, so it's just leading questions. It's maybe a too early to get the household level because of the household information is not available with the bureau itself, or
Yes, the household information is not available to the bureau.
thank you.
Hi, I'm Shiva. Today, the fintech companies are acquiring more customer, burning their cash. Even they are taking a lot of microfinance customer to their kitty. How the microfinance company going to address this?
To anybody specific or?
Anyone?
Okay.
See, the ecosystem is still very large. I think if you really look at it, people are talking about microfinance industry from the present about 2.5 lakh crores, moving on to about 12 lakh to 15 lakh crore in the next 4 to 5 years. There's room for everyone, and I think and also the other factors I think which has to probably be borne in mind is uh, two differentiating factors. The microfinance companies are more rural focused, large of them, many of them, as compared to the others. And the secondly, the fintech are actually addressing sub 25,000 or below 25,000, kind of a market. We have graduated, reached now about 45,000. So I think, the difference still lies across the market, which is being addressed by the fintech players, and we both can coexist. The lower side of the low spectrum, they can actually look at that, and the higher side, which is now probably coming out four, including the other factors which are moving ahead in MSME as well as in housing. I think the microfinance companies would probably address that, as compared to the fintechs. So that's what the difference is.
I have your permission, I'll just add a few things. Sir, acquiring customers, servicing customers, and collecting, anyone who can collect is most welcome. But if you can't collect, then it's a incomplete journey, and over a period of time, it is a self-extinguishing, whatever you call it, a button which will get pressed over a period of time that people will just run out of steam. So lending through fintechs, through easy customer journeys is most welcome, but an equal rigor in collection is the most important thing, I would say. Otherwise, portfolios will not stand the test of time.
Yeah, and I think related point is portfolio is the sheer affordability of credit, right? If you are running at a risk of double-digit portfolio quality, it does reflect in your pricing. And in a country like India, was thing. So I think we should close it. Thank you so much for your questions, and thank you so much to all the panelists for the discussion. And I think we end the session on a note of cautious optimism is what I would say, that which is very good, because as a lender, it's like no other financial services business. It's about collection. It's about ensuring that customer come backs to you and uses credit in a way that does not that brings progress to them and does not harm them. I think that remains fundamental. So thank you so much again, and over to you.
Thank you so much. Thank you, all the panelists. This was a really insightful session. And also, thank you so much for taking time out of your busy schedule to be a part of the summit. As a token of our appreciation, please accept our souvenirs as you exit the stage. Thank you so much.